So here's some more evidence to the theory that, well, not even really a theory. Here's just more evidence that the COVID-19, the pandemic, the shutdown, whatever you call it, our response to COVID-19, it hasn't equally affected everyone. There are some folks that have been able to prosper during this time, and some people have been severely set back. There are business owners that are closing up their shops. There are people that will be never be able to fully recover because of the toll it has taken on them and their finances. And on the other end, there are people prospering like never before. And it really is dependent on the industry that they're in and just some other factors, just how well they were uh, positioned to take advantage of the new environment that we find ourselves in. So, number of high value mortgages spike in Toronto. How does that happen during a pandemic? The number of mortgages in the $1 million to $3 million range in Toronto has significantly swelled compared to levels prior to the pandemic, according to a recent analysis by LowestRates.ca. There was a lot of expectation that housing prices might suffer and people wouldn't take on large mortgages because the economy would be down and people would be worried about their savings and their jobs. But it's been the inverse, said Justin Thuen, uh, founder and CEO of LowestRates.ca. I hope I'm saying his name correctly. But I mean, even the CMAC was warning about this cliff that we were potentially facing in 2021 after the deferrals ended. But what it seems like is a lot of folks, they just either just took advantage of the deferrals because they didn't necessarily need them, or it gave enough people enough runway so that they could figure out what they were doing afterwards. Because we haven't seen an increase in defaults or any arrears. Any sort of significant increase that would lead to the doomsday scenario that CMAC was looking at. So there are a lot of so according to Sean Stillman, principal broker at Mortgage Outlet, a potent driver of this development was the work from home revolution, which pushed down household costs significantly. Makes sense. People are no longer commuting to work. They're no longer driving to work. They can move to areas that are lower cost. You're not buying things on a regular basis. It's surprising how much the little expenses can add up on your way to and from work, even at work. You're buying your lunches, all those sorts of things. If you're downtown, that could add up to hundreds of dollars a month on top of everything else that you're doing. So, I mean, is that going to be able to push people into the $1 million to $3 million range for a mortgage? Maybe that's not going to be significant enough, but I mean, we take a look at all of the other things in combination with that, right? Stock market has soared. There's been a lot of people that have benefited, a lot of companies specifically, in the tech sector that have done very well during this period. So if you have a lot of folks in those sectors, finance and tech, that are seeing major gains, then maybe they're selling off some of their shares. Maybe they've made a lot of because yes, maybe they're just selling off a lot of their shares to capitalize on those gains, and then they're putting that into real estate, which is actually one of the theories. Um, so if you take a look here, all of a sudden people could be saving a few extra $1,000, so a few extra $1,000 a month. That's going to towards the down payment, Silman noted. Moreover, continuous economic volatility has pushed the stock market into uncertain waters and propped up housing as the safer investment choice for some folks. Obviously, that's not investment advice, but it is interesting to see what people are taking, what some people might be thinking is less risky than other asset classes. Is the stock market less volatile than real estate? Is the stock market more overvalued than real estate? I guess that those are the kind of questions that some people are probably asking themselves. So all of those things have come together to create a perfect storm for these $1 million plus mortgages. And if we take a look at a previous article, we've seen a significant increase in the million-dollar plus mortgages. So in the Toronto sales activity involving luxury homes valued at more than $3 million, swelled by 55.7% annually in 2020. That's a considerable rise. So a similar 4% increase was seen in the sales of homes worth over $4 million, up to 379 transactions. So we're seeing people, I guess, people that are at the top end of the income of the wealth spectrum. They're able to look at things business as usual, right? So they're able to take advantage of the opportunities that came about during the pandemic, and they're able to buy what they want. So the housing bounce back during one of the most tumultuous periods in recent history has been nothing short of remarkable. Christopher Alexander, Chief Strategy Officer and Executive Vice President of REMAX of Ontario Atlantic, Canada, a combination of both economic and psychological drivers contributed to a robust upswing in demand, influencing one of the greatest pivots in GTA's housing market history. Luxury condominiums also defied the trajectory observed in their more affordable counterparts, with sales of condo units valued at over $3 million, growing by 28.8% year over year. And what's really interesting is that this is fueled by domestic buyers, saying that full force in the GTA, and they were out full force in the GTA housing market in 2020, offsetting a decline in international home buying activity. With this segment largely absent throughout much of the year, the overall strength of the market is in what was essentially 9 months of activity was pretty incredible. So that's really interesting. So a lot of this is domestically fueled, and there's a lot of folks at the upper end of the market that continue to push it up. It's just really, just I think it's important to have a broad perspective when there are recessions or things of that nature that pop up, economic downturns that pop up, because you don't necessarily have to be affected by it. It doesn't affect the economy as a whole equally, which is the impression that is sometimes given that everybody is suffering equally. No, usually it's just certain sectors. I mean, obviously retail has been hit very hard, but conversely, we have finance sector and I guess obviously real estate as well as tech sectors. They're doing very well. So hopefully, this is just something to, I guess, an eye opener for the future in terms of who is really affected by, who's going to continue to be affected by future responses to pandemics, because this maybe has set a new standard for how we will deal with these pandemics in the future. Will we be continuing to shut down things, and will this always be the way we're going to deal with it? Maybe. And if that's the case, how do you position yourself? How do you prepare yourself for something that's maybe inevitable, right? You don't know when it's going to happen, but will you be able to work from home? Will you be able to work remotely? How will we have things set up that you can continue to earn an income if, in case the government doesn't provide a ongoing benefits program? Anyway, just some food for thought. Let me know what you think. What were your thoughts when it came to the economy? Did you think did everybody was getting hit equally? Did you already think that there were some people that were benefiting while other people were suffering? Let me know what your thoughts are. Anyways, have yourself a great rest of your day. Peace.